Cheers, ladies and gentlemen. Janet Yellen's getting desperate. What's going on, my friends? Just wait for this thing to go live here. Just a few seconds in. Let's give people a chance to jump in here before I get started. We get started in about 1 minute. But if you're just arrived, we do have to talk about the 4 times that the United States has already defaulted. I can't believe people don't know about this, but they actually believe Janet Yellen and the federal government when they say that we have never had a default, which is an absolute fallacy. It's good to see all you guys and girls. Thanks for joining us. But let's not wait too long, you know. People will have the chance to rewatch this video if they miss the live stream. What's going on, everybody? It's great to see you. We need to talk about this right away. There are too many people out there that don't know that the United States has already defaulted 4 times. Let me just adjust this a little bit. Get less sunlight. Hey, it's good to see all you guys and girls as well. Appreciate the comments. So, in 1862, there was a default on the United States by the United States government caused by the Treasury's financial difficulties in trying to pay for the Civil War. In 1933, there was a default by the U.S. government on gold bonds. In 1968, there was a default by refusing to honor the government's explicit promise to redeem silver certificate paper dollars for silver dollars. And in 1971, there was a default breaking of the U.S. government's commitment to redeem dollars held by foreign governments for gold under the Bretton Woods Agreement. Now, if you guys follow me on Twitter, you've already seen this. This was from a tweet I put out yesterday or a couple days ago here over this past weekend. But yeah, don't let the government lie to you. Just like they said inflation was transitory and all this other bullshit. We all know it's an absolute farce. It's a fallacy. The debt ceiling talks today continued as we are fast approaching this June deadline set by Janet Yellen. And today, in case you're unaware, today Janet Yellen is asking the federal government if they can have more time to make their June payments. Janet Yellen is already concerned about making their June 1st and 2nd and 3rd bond payments and no payments. She stated this week that, quote, actual defaults could be a few days or weeks later than estimated. But early in the week, the narrative seemed to be that progress was being made, but discussions later stalled. McCarthy today says he and Biden are nowhere near a deal yet. He said, quote, he said McCarthy to the other GOP Republican representative said, I quote, I need you all to hang with me on the debt limit. We are nowhere near a deal yet. I told the president 3 things: no clean debt limit, no raising taxes, and spend less money. Remember where we were. They refused to negotiate. He also said, we owe Garrett Graves and Patrick McHenry a round of applause. They made a mistake to not negotiate. Let's stay strong together. End quote. McCarthy also showed a video with a chronology of Democrats saying they wouldn't negotiate. Thanks for the super chat. You're too kind, my friend. You don't have to do that. But always appreciated. You know, so McCarthy literally is giving the GOP a pep talk on not negotiating and blaming the Democrats for their mistakes on not negotiating up until this point. Literally putting out a video with in chronological order of Democrats saying they wouldn't negotiate on this debt limit. And what happened this week? The Treasury General account saw the largest drawdown earlier this week, falling from $140 billion to $86 billion between May 12th and May 15th. And this week, it finished just around $57 billion. So looks like we went from $140 billion to $87 billion to $56 billion in less than 2 weeks. This has definitely sparked worries, saying that the default date could come sooner than expected by old Yeller. The White House also stated that the stock market could crash as much as 45% in the event of a default, and Biden said that he's considering using the 14th Amendment in order to raise the debt limit. However, the 14th Amendment states that the validity of the public debt of the United States shall not be questioned, and therefore it's argued that this could be used to bypass Congress if needed in order to raise the debt limit. However, it would very likely cause a lengthy legal battle and not be straightforward. This is a massive game of chicken between the GOP, Republicans, and the Democrats. And it is very likely that the Republicans will point the fingers at the Democrats and the Democrats will point their fingers at the Republicans. And this could be the number 5 default in the United States government's history on our debt. What would that do? It would cement Biden as just cement him out of the 2024 running for president. He would not have a chance in 2024, as probably wouldn't any Democrat. So the Federal Reserve delivered 14 speeches last week, 14 different speakers. Jerome Powell spoke on Friday last week and didn't provide any new information. He basically said the following: inflation is too high and it will take longer than expected to cool. What does this mean? Rate hikes will last longer than expected. He also said bank credit tightening likely means the Fed doesn't have to hike rates as much, meaning global liquidity index will continue to fall. Meaning, what else happens when the liquidity index falls? So does the stock market and jobs and the economy and lending, etc. Powell also said the Fed is worried about the lagged effects of their rate hikes, meaning the soft landing is pretty much out of the question. We're looking at a hard landing, ladies and gentlemen. And if you still think we're gonna make a soft landing here, God bless you. God bless your naivety. I wish I could feel the same way. And keep in mind, I'm not a bull nor a bear. I'm a realist. And Powell also said that further rate decisions will be data dependent. In case you guys didn't know, BlackRock is now saying that the Fed will pause rate hikes in their next FOMC meeting in June. The Federal Reserve's balance sheet decreased by $46 billion, but still stands at $8.5 trillion. Trillion with a T. The U.S. bank emergency borrowing increased by $3.6 billion to $96 billion. The discount window borrowing decreased by $275 million, a slight decrease of $275 million, but the bank term funding program increased by $3.9 billion with a B. It doesn't really make that $275 million decrease in the discount window look very small, does it? Because $3.9 billion increase in the BTFP, the bank term funding program, is absolutely massive. The bank term funding program lending now stands at $87 billion with a B. The discount window and the BTFP are both means by which financial institutions borrow collateral-backed emergency liquidity from the Fed. Now we've got the RRP, the DW, and the BTFP, and for those of you that are unaware, the reverse repurchase program, the RRP, is at $2.275 trillion today, $2.275 trillion, and it'll be the same thing the day after tomorrow and the day after that. And so we continue. Securities held outright by the Federal Reserve decreased by $30 billion as they try to decrease their balance sheet, but it remains at $7.77 trillion. This typically includes U.S. Treasuries, mortgage-backed securities, government-backed debt securities. And these government-backed debt securities are debt issued by government-sponsored entities like Fannie Mae, Freddie Mac, and FHLBs, Federal Home Loan Banks. The U.S. Central Bank leading economic index fell by 0.6%. This is the 13th straight month of decreases in the leading economic index by the U.S. central banks. The LEI is a combination of leading indicators of the U.S. economy and is supposed to predict future economic performance by around 7 months. A quote from the report reads, "The Conference Board forecasts a contraction of economic activity starting in the second quarter, leading to a mild recession by mid-2023. U.S. retail sales are in, and guess what? They're worse than expected. But they did increase 0.4% month over month, but they missed the 0.8% expectations. This is a reversal of the declines we saw in February and March, but as you can imagine, retail sales also came in lower than expected. Last month was 0.5, and this month is 0.4. Retail sales are basically a barometer of consumer spending. And that accounts for 70% of the U.S. gross domestic product. The index is based off of survey responses from business managers in New York State manufacturing industry. The New York Empire State Manufacturing Index shows a massive contraction. And as I was saying, this is based off survey responses from business managers in New York State manufacturing. Readings below zero indicate a contraction. New orders and shipments have nosedived this month. Capital spending index fell to a 3-year low, indicating that businesses are planning on being more conservative with their funds. So the expectations for that were positive 3.75. Previously, they were positive 10.8. But in reality, they came in at negative 31.8 for the New York Empire State Manufacturing Index for May. This is the largest one-month drop on record for the index and suggests a significant contraction in manufacturing in New York State. And you may as well apply that to all the rest of the states in the country as well. The Philadelphia Fed Manufacturing Index came in slightly above expectations and improved significantly in May, but still came in at negative 10.3 compared to the negative 19.8 expectations. Previously, it was at positive 31. So we went from positive 31% to negative 10.3%. However, business conditions still signal a massive contraction. Let's look at the U.S. housing. U.S. housing weakness continues despite housing starts coming in fairly hot. Existing home sales, representative of around 90% of the United States housing market, took another nosedive, making for the 20th consecutive year-over-year decline in the index. Building permits, a leading indicator for future housing starts and construction, also disappointed, pointing to possible further slowdown in housing. MBA mortgage applications were negative 5.7%. Previously, last month, they were positive 6.3%. Building permits were negative 1.5% month over month in April. Expectations were positive 0.2%. Housing starts were positive 2.2%, beating the expectations of negative 1.5%. But existing home sales last month were at negative 2.6%, and this month, negative 3.4%. It doesn't take a fucking rocket scientist to figure out that the everything bubble is coming to a massive, massive, fast end. Jobless claims came in below expectations this week after last week's figures were skyrocketing, largely due to fraud attempts in Massachusetts. Jobless claims came in at 242,000 jobless claims, just barely beating expectations of 254,000. But last month, we saw 264,000 as well. Jobless claims have been gradually trending higher, suggesting the beginnings of softening in the U.S. labor markets. And in the United Kingdom labor market, for the first time since February of 2021, the number of UK payrolled employees declined month over month. And this does not include those under self-employed status, because as you all know, self-employed individuals do not have the opportunity to apply because they will not get unemployment benefits. Furthermore, UK jobless claims surprised to the upside. This means that more people are claiming unemployment. The cost of living crisis is bringing previously economically inactive people back to the workforce with higher labor force participation. Inflation is destroying people's savings account and forcing them into more debt. That is exactly what this means. UK payrolls change for April are negative 136,000. Unemployment rate climbed to 3.9%, exceeding expectations of 3.8%. The claimant count change, UK jobless claims for April, were positive 46,000, greatly overshadowing the expectations of negative 15,000. So instead of negative 15,000 jobless claims in April, there was positive 46.7 thousand. And the month before, there was positive 26,500. The employment change, expectations was at 160K, but still that was beat with 182,000 people finding a job. But there were still 556,000 working days that were lost in March due to strikes, and job vacancies fell 55,000 quarter over quarter to 1,083,000. The 10th consecutive decline for job vacancies. 55,000 only. So we have 55,000 job vacancies total in the UK and 46.7 thousand people looking for a job in April, and 26,500 more looking the month before. Wow. Eurozone headline inflation came in as expected, but increased again month over month, guys. Energy and services inflation rate increased, meaning and food, alcohol, and tobacco cooled. However, headline inflation is still at 7%, higher than last month's 6.9%. And core inflation was at 5.6%, slightly lower than last month's 5.7%. What about industry? Eurozone industrial production came in way below expectations in March at negative 4.1% month over month. The expectations were negative 2.5%. It was nearly double that. Negative 4.1% month over month, and down negative 1.4% year over year. And the Eurozone GDP for the first quarter came in as expected at 0.1% growth for the quarter. 0.1%. Now you got to look at the rest of Europe and the world to figure out that this is a global equities disaster in the making. Economic data coming out of Germany, which is the fourth largest economy in the world, continues to be poor, and economists' opinion is that the country may slip into a recession this year. Germany accounts for 30% of the entire Eurozone GDP. Now, the ZEW Economic Sentiment is a collation of survey responses from 350 German economists and analysts on their assessment of the German economy now and in the next 6 months. And the ZEW Economic Sentiment, which we just discussed, came in way below expectations this month. Previous month, it was at positive 4.1. The expectations this month were for negative 5%, and it came in at negative 10.7%. More than double, twice as bad as expected previously. The report also adds that economists in Germany expect worsening of already unfavorable conditions. The economists expect worsening of already unfavorable conditions in the next 6 months, and that Germany may slip into a recession. Unfavorable expectations are partly due to the possibility of a U.S. default and the European Central Bank increasing rates further. Why? The reason being, we just told you why. Because inflation is still heating up in Europe. Now let's take a look at Canada, our neighbor to the north. Canadian headline and core inflation rates both came in, take a guess, hotter than expected. I told you guys, inflation was not over. We are in a deflationary and an inflationary period at the same time. This could be called stagflation. Now, this may serve as a warning sign to other central banks as inflation may be reaccelerating in Canada, as they were one of the first central banks to pause rate hikes this cycle. And that's exactly why Jerome Powell and the Fed are scared to pause rate hikes right now in the United States. They made a mistake by going down to 0.25%, and they know that. They should have kept raising at 50 basis points or even 75 basis points for an extended period of time. But the lagging indicators used by the Fed always leave them behind the curve. Headline inflation in Canada was previously 4.3. It was expected to be at 4.1, but is actually at 4.4%. Core inflation was expected to be at 3.8, and it's at 4.1%. Now, taking a look at the UK and the US, labor markets are showing signs of weakening. Let's see here. You guys can't hear me? I'm sorry if you guys can't hear me. Yeah, I don't know if you guys still can't hear me or not. I did get a notification there. I got a phone call. All right, my apologies about that. I'm going to continue. I'm almost done. I hope you guys can hear me. So, the UK and the US labor markets are definitely showing signs of weakening, despite employment being at historically very tight levels. The US leading indicators continue to suggest that a recession will continue in the US by the end of 2023. Signs of weakening in the manufacturing sector in the Philly and the New York regional Fed surveys indicates that this is a nationwide problem. The debt ceiling talks will no doubt continue to take the spotlight as worries about the possibility of a U.S. debt default continue to grow. The drawdowns seen from the Treasury General account are worrying some that the June 1st date could come even sooner than expected and extraordinary measures may need to be taken. The markets are now pricing in an 82% chance of a rate hike pause at the next Fed meeting per FedWatch and per CME FedWatch. But as I just explained to you guys, if you just got here, there have already been 4 defaults in this country. A lot of people just don't realize it because they're getting gaslit by Janet Yellen and the mainstream media. In 1862, a default caused by the Treasury's financial difficulties trying to pay for the Civil War crippled our economy. In 1933, a default by the U.S. government on its gold bonds did the same. And then, even more recently, we had 2 more. In 1968, there was a default by the United States refusing to honor its explicit promises to redeem silver certificate paper dollars for silver dollars. And in 1971, there was default breaking of the U.S. government's commitment to redeem dollars held by foreign governments for gold under the Bretton Woods Agreement. Plain and simple, don't believe the bullshit that we've never defaulted, because it's already happened 4 fucking times. Make sure you're properly hedged. Even if we don't default, which would be ideal to not have a default, liquidity does not look good, the economy does not look good, and the propping up of the stock market by hedge funds and algorithmic traders and the plunge protection team headed by Janet Yellen can only last so long. Retail knows the game. And the fact of the matter is, I don't think that most people are stupid enough to get tricked by a bull run in a bear market, because that's exactly what this is, a bear market. That being said, make sure you're properly hedged. Janet Yellen has already told us multiple times that the greatest risks to financial stability are over-leveraged hedge funds and the shadow banking sector, which consists of hedge funds and money market funds that have overly shorted way too many stocks and bonds. And right now, the mega caps, like the FANGMAT stocks, are the only thing that are actually propping up the S&P 500 and the greater indices. Act accordingly. This is Boss Blunts. I wish you peace and wealth. If you guys are looking for a broker-dealer that's not looking to fuck you over at every turn, you should look into Xchange.com. There's a link in the description below. Feel free to add your email if you'd like to sign up for the beta, the Founders Program, or to get more information. We expect to launch later this year. And I'm looking forward to doing something to actually help retail investors, because these brokers don't give a fuck about you. Don't forget about that. Red or blue, don't give a fuck about you. Hedge yourself, act accordingly. Thank you, everybody. Before I go, make sure you plant some fucking food. Get some damn food going. Get some chickens. Make yourself a little more self-sustainable. Don't deal with inflation. Not by getting raped by it, at least. Deal with it properly. Act accordingly.